all need to make smart decisions with our money. The Long-Term Investor podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at Plancorp and the author of Making Money Simple, Peter Lazaroff.
Welcome back to The Long-Term Investor. In this episode, I'm joined by Liz Muirhead, a senior portfolio strategist at Vanguard, who was visiting our office in St. Louis to do the mid-year outlook with our advisors. And it turned out we had just set up our brand new podcast studio in the office. So I asked Liz, unprepped, to hop into the studio and talk about all sorts of different topics. We talked about why individual bond ladders often provide more psychological comfort than economic advantage, where active fixed income can add value, how mega IPOs enter indexes, and why broad diversification means that you already own tomorrow's market leader. And honestly, as I tried to summarize the conversation, I realized that doesn't even capture half of what we talked about. So this is a longer episode. We dive into all sorts of different things. And there was one resource I mentioned during the episode that is linked at the top of the episode description. Basically, it's a calculator that Plancorp built to estimate your annual fee and the value that you could earn by working with a professional advisor. As always, you can find detailed show notes at thelongterminvestor.com, but enough of me. Let's dive into the conversation with Liz Muirhead. Hi, I'm Peter Lazaroff, Plancorp's Chief Investment Officer, and today I'm here with Vanguard's Liz Muirhead. Liz, thank you so much for joining me today.
Thank you for having me.
Maybe you could give a brief background on who you are and what you do at Vanguard.
Absolutely. Happy to do that. So I actually just celebrated my 29th anniversary with Vanguard.
Wow,
so
congrats.
The gray hair comes with the with the tenure. I started in the back office, spent 17 years in our manager due diligence department. And then for the past 5 years, I have been a senior portfolio strategist working with advisors on broad topics like understanding markets, portfolio construction, and actually sometimes even digging deep and going through advisors' models and helping them figure out how they can do a bit better.
Very cool. And Vanguard, I feel like when a lot of people think about Vanguard, they think about Jack Bogle, they think about index funds, they think about the power of simplicity. Mm-hmm. You know, one thing that I find when I talk to people who are interested in investing, but either aren't advisors themselves, maybe some of them work with an advisor, maybe some of them don't, they often feel like investment management has become commoditized.
Sure.
And I think that Vanguard amongst a lot of people have done great work to make some version of investment management commoditized. You know, like it has never been easier to build a diversified portfolio of cheap market exposure.
Yes.
However, there are a lot of things involved in the investment management process that aren't necessarily a commodity. You sort of made a face when I said that phrase. So tell me your reaction to that. Like, what do you think about that?
So Jack Bogle solved a major problem for end investors, which is access to institutional quality management. So direct stock exposure, the ability to invest in the S&P 500, for example, and then later the total market. That was something that was reserved only for professional investors, institutions. And so being able to give access to that broad diversification, especially at very low cost, was a novel idea. The challenge is that Jack believed that if people had access, that would be enough. And over time, we've learned that just having access to the right products doesn't necessarily mean that you're going to use them appropriately. I mean, like I can buy an entire gym system for my basement, but I might benefit from actually having somebody show me how to use it all, make sure my form is good so I don't get injured. Index funds are great, but I've often seen people misuse them.
Yeah, it turns out that hundreds of thousands of years of human hardwiring and evolution has not just been scrubbed away. Like you're never going to take the human out of human nature.
Imagine.
I think a lot of what I'd like to talk with you about today are some of these areas that perhaps show how investment management is not just a commodity, how there are like different offerings and different ways in which both an advisor can add value, but I'd also like to address some like misconceptions that not just individual investors have, but that maybe even financial advisors have. So why don't I start with the one that I feel like I've spent more time in the past 12 months talking diligently about,
Sure.
individual bonds versus bond funds. Now, let me set the table. Individual bond funds, that if you wanted fixed income exposure, that used to be the only way you could get fixed income. You had to buy individual bonds. As a result, people would put together bond ladders. I think that a lot of the professional community has gone past the point and has seen the research and has seen the product development to say, yeah, you can certainly improve upon bond ladders. But with individual investors, I still see them obsessed about the certainty of getting their principal value back at maturity of the individual bond.
Yes.
Give me some background on how you think about individual bonds versus bond funds and maybe some of the misconceptions you see among both individuals as well as advisors themselves.
Sure. This is a topic that comes up quite a lot, Peter. One of the things that we've seen is that holding individual bonds can be helpful as a behavioral tool for clients because that certainty, not having to see that bond mark to market, that bond is changing value every day, but that value change isn't visible to clients. And so it helps them behaviorally stick with the plan. The challenge is that if you're using individual bonds, you're leaving a lot of money on the table. So a couple of examples. In most cases where we see individual bond portfolios, it's where the client has an indeterminate time horizon. So the client has their retirement portfolio. They know they're going to retire maybe at a particular age, but they don't know how many years they're going to live into retirement, how much money they want to leave for their heirs, charitable bequests, etc. And so they have a very long-term and uncertain time horizon. If they hold individual bonds, those bonds are going to mature. And then what are they going to do with that money? They're going to buy another individual bond. Miraculously, this is what the bond mutual funds and ETFs are already doing. So they are laddered bond portfolios, but they hold a lot more bonds. They're professionally managed. And because they're professionally managed, you're also getting better trading costs and liquidity. So these are all really positive things. Now, there's a time and place for individual bonds. Let's say that, my son was going off to college and I wanted a bond to mature each year in order to use those proceeds to pay his tuition. That would be a great reason to have a laddered bond portfolio because when that bond matures, I know for sure how much money that's going to be. I'm going to pay the tuition bill and I'm going to go on with my life. But in the situation where I'm taking that money and now buying a new bond, I'm subject to reinvestment risk. What are interest rates today versus where they were years ago? And in that bond portfolio, because it's just for me and I'm the only investor in it, I'm probably not going to have as much money to build as much of a diversified portfolio. So when we look, especially on the muni side, what we tend to see is people concentrate those individual bond portfolios in very short-term bonds. They leave a lot of return on the table because the muni yield curve is very steep. So you get a lot more yield by having 15 or 20-year bonds than you do by having 5 or 10-year bonds. The second thing is that they're focused in the highest quality of investment grade. Whereas if you have a diversified bond portfolio, you can use AAA and AA, like people do in individual bond portfolios, but you can also hold single A and triple B. Those are still investment grade ratings, but there's a lot more value. And there's an opportunity, too, to differentiate with active management in that single A and triple B credit rating bucket. So we see a lot of that nuance in how people are leaving significant amounts of return on the table in an individual bond portfolio. And they don't realize it because the individual bond portfolio isn't marked to market and they don't really have a good sense for how it's performing relative to an enduring, stable duration, stable term mutual fund or ETF.
First of all, I couldn't agree more with everything you're saying. There's so many tangents I want to go down, except the very last thing you said is going to make me pivot again and say, they don't know how they're performing. I don't think any individual investor really knows how they're performing. I have seen dozens of spreadsheets from investors over the years trying to show me what their performance is. And people we don't have to get into the complexities of how to calculate time-weighted return, but unless you are doing that, you don't know what your performance is. And most custodial websites, I want to say all, but I don't know if it's true, but most custodial websites don't provide that information. So the ability to not understand your performance, we talk about, is investment management a commodity? Performance reporting is a big deal, particularly transparent performance reporting. And with bonds, you don't know what the costs are because they're embedded into your yields. You really don't know what your opportunity cost is without seeing a benchmark and a time-weighted return of those individual bonds. I just feel like it's a place where we could spend an hour going over misconceptions, but I'll pick my battles here and just hone in on one other thing you said, where there's a lot of opportunity for active fixed income management to add value. Now, people who think Vanguardian, they typically think indexes. Aren't indexes great? But the bond world is different than the stock world. Like, let me paint a picture. Mm-hmm. You and I walk into a bank together, and I have debt out the wazoo and just like a little bit of income, whereas you come in with a pristine balance sheet, you have a high income, lots of assets. If the bank were an index fund, they would lend me more money just because I'm more indebted. That doesn't make a lot of sense. There's also just, I think more than half of the buyers of fixed income don't have economic interests. So people buy bonds because they have certain liquidity requirements. Right. There are just all sorts of opportunities to add value in active fixed income. I happen to think that Vanguard has a very thoughtful way of thinking about active fixed income. Like, where are some of the other things that you see there being a big benefit of utilizing an active fixed income portfolio?
Sure. Well, I want to be clear. We have index and active. We love all our children. But in the active fixed income arena, what we see is there's a real opportunity for differentiation from a credit perspective. Think about the U.S. stock market. We're talking about thousands of issuers, 4 digits. In the bond market, we're talking about tens of thousands of issuers, 5 digits. And in many cases, those issuers have multiple bonds. So take a company like GM. There's one GM stock. There are hundreds of GM bonds. And so a good active manager can look at that range of bonds and can determine this bond has a relative value that makes it more attractive than that bond. So it would be like you and I walking into the bank with very similar balance sheets, but you have a better yield than I do. And so the bank's like, that's attractive. I want to make that investment. That's the power of active management in fixed income. The challenge is that there are a lot of active managers out there that charge very high fees. And in fixed income, you can only add so much value through active management. So if you're charging a very high fee, the way that you generally compensate for that is by taking more risk. And that's where we see, in some cases, indexing has been a way for people to get that same risk exposure, but use index products to do it and use factor tilts within that. So the active management is the overlay. It's how you use the index products instead of the bottoms-up selection. We think there's an opportunity to add value in both.
Yeah, I really think that if you are an individual investor or an advisor who is using individual bonds, other than the use case that you had suggested, I agree, where you're matching an asset with a liability, whether it's I have a tuition payment in X years, and so I want to lock that in. You're using it for the investment, long-term investment portion of your portfolio. There is a lot of new research. There's a lot of new product that you really need to start to familiarize yourself with. Investing isn't always about just earning the highest return, no matter what. You do have to have a portfolio you can live with and meets your objectives and is aligned. But I tend to find that when people come to us at PlanCorp, the number one place I'm like, oh, well, there's easy value to add is in the fixed income portfolio. But I want to go through some more like misconceptions. Otherwise, I'll talk to you about fixed income for an hour. I think it's fascinating.
We might lose the audience.
That's right. Well, here's something the audience definitely is into because it's all over the headlines is SpaceX was the first of a series of mega IPOs. Yeah. When I think of, again, Vanguard managing one of the largest, if not the largest, like total market index product, a lot of people were concerned with how that one specific mega IPO, as well as some of them coming down the pike, might influence the market, might influence exposure? And what are some misconceptions that you've seen both advisors and individuals have about the mega IPOs in 2026 and beyond?
I think one of the biggest misconceptions that I kept hearing, even just from my personal friends, was, oh my gosh, SpaceX is going to come to market and it's all of a sudden going to be the biggest stock in the index, because they kept hearing in the press it's been valued with a $2.6 trillion market cap. The reality is that inclusion in indexes is based on what we call free float, which is what percentage of shares are available for sale. And so looking at the free float of a company like SpaceX, we're talking about a market value that is actually closer to the size of a FedEx or a 3M than the value that was being quoted in the markets, in the press. And if we actually look at some of the indexes that have already included it, the largest inclusion that we see is in the completion index from S&P, which is 1.3%, I think the last I looked. In more of the standard large cap indexes, we're talking about less than 0.5%. So it ended up being much smaller in people's portfolios than the headlines in the press made them believe. And I think we'll see something similar with some of these other mega IPOs. The reason that some of them are coming to market is honestly to allow some of the owners of shares to generate some liquidity and some diversification for themselves. It's not so that the private owners can completely unload all of their holdings. They are definitely not interested in doing that. And in fact, when it comes to Elon with SpaceX, I think he has a 366-day lockup before he can even sell a single share.
I'm sure he can borrow against him, but that's a topic for another day. You know, it's interesting to me about IPOs in general. There hasn't been an IPO appetite in my memory since like the Facebook IPO. And prior to that, you know, you have to kind of go back to the tech boom, the tech bubble. And I'm not even remotely considering there's a bubble here. I'm just sort of saying like this is sort of a renewed place of interest among investors of all types. It also sort of highlights that there's a lot of appetite still for individual stocks, where I feel like the financial advice profession has become much more well-versed in the idea that individual stocks are much riskier than they seem, and the likelihood of trailing the overall market is substantially higher than most people are aware of. What are some misconceptions and mistakes that you see among investors who are owners and traders of individual stocks?
So often what I see is people are making decisions based on recent backward-looking performance. And certainly we're wired as humans. We use social proofing. We get opinions from others. You know, I'm here in St. Louis. If I were looking for a great restaurant to go to, I would go online and look at ratings and say, okay, this is a good restaurant. Let me go give it a try. If I'm traveling to another city, I might look at the weather report to figure out what I should pack. Those same types of tools that we use to make decisions in our everyday lives are actually very unreliable tools when it comes to deciding which stocks to buy. If we can go back in time, actually a little bit, one of the things that I often like to ask people is, would you have known what the best stock is today in order to buy it back in that historical period? So one of my favorite questions to ask individual investors is, if you could, would you have wanted to buy NVIDIA back in 2003? If I ask that of a room of 150 people, every single person raises their hand. And then I ask them, how many of you own a total market or S&P 500 index fund? And most of them will raise their hands. And I'll say, congratulations. You bought NVIDIA in 2003. It entered the index when Enron left. So that's a really important point for people. We don't know what the NVIDIA of 10 years from now is going to be. But if you're in a well-diversified portfolio, you probably already own it. If you're buying whatever stock has been hyped up on whatever news show you watch or you saw on Twitter, you may miss it. And that could be very unfortunate.
Now, I'm of the opinion that the starting point of a portfolio, like you're starting from scratch, like how do you build a portfolio? The average investor should own the whole market as best they can, which, you know, if I'm probably a little bit oversimplifying, it means just owning like total market index funds.
Right.
I think what's interesting over time is how there's been a lot of research for many, many years that while index funds are a great way to own the whole market as cheaply as possible, Jack Bogle coined the cost matters hypothesis.
Absolutely.
I do think people get confused that index funds are a case for the efficient market hypothesis. They're not really. They're really just about if you keep costs low, you get to keep more of your return. And that's great. I equate it to fastballs used to be measured with just velocity. Well, actually, even before then, people just sat behind the dugout and squinted and they're like, oh, the pop of the glove was really loud, or, oh, the swing of the batter was just, so much effort and they weren't even close. And then velocity came in. Mm-hmm. And if you could throw a ball fast, you were a prospect. And if you couldn't, you were not. And if it didn't work out, like, hey, here's this guy who throws 95 miles an hour. And if he didn't pan out, it wasn't ever the scout's fault. It was just, like he didn't live up to his potential. But then we had stuff, they have these tools, StatCast and PitchFX, where they see spin rate, they see the angle of the wrist, they see the finger grip, all of these little characteristics that explain why a fastball is great. Mm-hmm. What I think a lot of the investment community is unaware of is that the same thing happened with indexing. Indexing was first developed not to be a performance vehicle, but to measure performance. We had all these stock pickers out there in the world. We didn't know how anybody was doing. So let's measure it. And we realized that there were characteristics, this market exposure that explained it. But there were other characteristics as well, things that here at PlanCorp we call factor. Liz, you joined me on my podcast a few years ago to talk about indexing versus factor investing. And, there are things like the relative price of a company versus its fundamentals, the relative size of a company, its profitability, its momentum. There are characteristics that drive what an expected return for a stock might be. And so while I don't want to put words in your mouth, but I believe you agree with me that buying individual stocks is not necessarily the optimal way to invest. You want to be diversified broadly. Index investing versus something called factor investing, there may not be a right answer, but there is a lot of opportunity. Do you mind talking a little bit about the differences between, that was a long introduction for a question that I really just wanted to talk about baseball. But ultimately, talk to me a little bit about index versus factor investing and how people should think through the choice of choosing one strategy versus another.
Sure. So in an index strategy, you're really just accepting what the market will bring you. We know that there are equity factors that have outperformed during certain periods of time. We've seen the value factor, the small cap factor. We've seen volatility, quality. They outperform during some periods of time and they underperform during some periods of time. So if you are somebody who has the risk tolerance to persist through a period of underperformance, factor investing might be a good option for you to emphasize some of the things that you value from an investment perspective. If that moment where quality, because I really like quality personally, if that moment where quality has underperformed for multiple years is going to make you say, forget this quality stuff, I just want to invest in what's working, you are better off just sticking with indexing. So it's really about your risk tolerance and your appetite for that. Are you willing to try to extract some additional return from the market by emphasizing factors that we know have provided some enduring value over different periods of time? Or do you just want to keep it simple and accept what the market gives you and know that you won't have any of that regret?
Yeah, I think regret minimization is a big area where an advisor is working with a client, recognizing that we don't live in a spreadsheet and that the mathematically optimal choice isn't always the right choice for an individual.
Jack Bogle used to say, the enemy of a good plan is a perfect plan.
I love that.
You have to find the plan that works for clients, not just the plan that the academics would tell you is most sound.
Well, and I think that if you're an individual, the more of these things that deviate from an all-index portfolio, the more likely you are also to get stung or get hurt or injure yourself. I'm going to keep the analogy getting worse and more grotesque. But when you go into factor investing, you mentioned quality. I mentioned profitability. Mm-hmm. Similar, but not the same.
Exactly.
And also, I said cheapness, you said value. We were referring to the same thing, but people define them differently. And then products implement them differently. And so, I'd led off the conversation with, I don't believe investment management is a commodity. Despite the fact that there are a lot of online influencers, there are a lot of do-it-yourself evangelists who aren't necessarily advisors, aren't necessarily coaches, but they're widely followed, and maybe they don't even consider themselves influencers, but they say asset management's free. It just isn't. There is a lot of complexity. You also have this degree of customization and personalization, whether it's through a separately managed account, whether it's through trying to diversify away concentrated stocks through an exchange fund or a 351 exchange or option strategies. There are all these areas where you can add value with an advisor, but you can't necessarily get on your own. I mentioned SMAs. I do want to talk about tax loss harvesting real quickly. I think our most educated clients, the most educated individual investors that I interact with, think that tax loss harvesting adds value.
Our research agrees.
Yes. But how you tax loss harvest matters quite a bit. Tell me a little bit about what your research says on the topic of tax loss harvesting.
So it's very interesting. We think that tax loss harvesting is an area where advisor relationships have been able to add meaningful value. And I have to tell you, I'm a CFA charter holder. I do this every day. I am not paying attention to my portfolio enough to optimize a daily opportunity to tax loss harvest. But one of the trends that we've seen in the industry, and this is a tool that is available through advisors today, not through to individual investors, are these separately managed accounts that can take a group of holdings that look like the S&P 500, but exploit opportunities for tax loss harvesting, sometimes even on a daily basis. So the client can then build up losses that help them tackle one of the biggest problems of index investing, which is eventually you need to liquidate this portfolio. And if you've done your job well, you have significant gains. So getting to that next stage where a client is in retirement and trying to draw down their portfolio can result in them having significant tax bills. And that's the point at which the complexity can start to get so great that they raise their hand and say, you know what, I need somebody to help me with this.
The tax loss harvesting research that Vanguard has provided, along with a lot of other thought leaders and academics, has been really influential in the way that we design our processes. And most tax loss harvesting for a long, long time required a down market. So let's say I own an S&P 500 index fund, and let's say I bought it, in 2021. 2022 comes along, there's a bear market in stocks, bonds are down a lot, and I get the opportunity to sell that ETF that's tracking the S&P 500, capture a loss, use it against a future gain. But oftentimes, there are individual companies within the S&P 500
Absolutely.
Who are trading at a loss. So I'm going to overgeneralize and say, let's say Pepsi is down and you could sell Pepsi and buy some Coca-Cola and still have, I realize Pepsi owns other things beyond cola products, but, help me out, people, where one pharmaceutical for another, or one oil company for another.
Airbus and Boeing, if you have a global portfolio, absolutely.
That's a perfect one. See, this is why you're the senior portfolio strategist. So I think, the real value here of a separately managed account to me is if you believe in tax loss harvesting, as you mentioned, this is an opportunity to do it on a daily basis. The research shows that daily makes a bigger difference than looking quarterly or annually or monthly. Absolutely. But also, instead of having to wait for the whole market to be down, what most people don't realize is how many individual stocks are down in a given year where the market is up.
Absolutely. I mean, we see that often some of the years where the market is down the most on an individual day are years where the market is up, and vice versa. That is multiplied tenfold when you look at it on an individual company basis. So if you can take advantage of, for example, look at last year, the month where we had what I like to refer to as the tariff tantrum, there was a lot of stock volatility during that month. And so there were opportunities to extract losses from a portfolio if you were prepared to take advantage of it. We saw the same thing earlier this year with the geopolitical conflict and the war in Iran. So we see this happening over and over again. And there are opportunities at a point in time that you then can take advantage of and extrapolate into a broader portfolio if you are positioned in a way to do that from the start.
And we've touched on a lot of what I would consider customizations or personalizations or just broad trends in research that I don't think people who are individual investors are always aware of. But what I really want to focus in on is a study that Vanguard is celebrating the 25th anniversary of, which is Advisors Alpha.
Yes.
Tell me, so where does the value of an advisor come from? And why is it that investors struggle to see that value in the first place?
One of the interesting things is that we've really found that investors approach choosing an advisor and they think that the primary extraction of value is which investments the advisor chooses. And I'm not saying that that's not important, but there is so much more to it than that. The guideposts, the plan, helping you stay consistent. It's almost like if you hire a fitness coach, it's not about whether they can design the best workout for you. It's about coaching your form to make sure you get the maximum amount of value out of that workout and then helping you maintain your focus and consistency. So that's one of the powers of an advisor. We see that through behavioral coaching. We see that through the tax loss harvesting. We see that through rebalancing discipline. We see it through helping manage overall costs. There's a lot of different aspects to the value that an advisor brings to a portfolio. And we've quantified that as being more than 3% annually over time, but it's not earned consistently year over year. It's earned in those moments where things could go off course and the advisor saves you from a behavioral mistake, or things could go off course, but the advisor saves you from a horrific tax mistake, which we've seen a few of those over the years, and very unhappy clients. So these are the types of things that are so important. I think about it as well, like to use another analogy, we have so much technology in our cars today. And one of the things that we have is we have like the blind spot monitor.
Oh, I need that.
I totally do too, especially as I get older. Sometimes I can't quite look in my blind spot the way I used to when I was 20. But I'm driving down the road, I want to change lanes, and I put on my turn signal, and all of a sudden I have this flashing reminder on my screen, there's somebody in your blind spot. And so I'm going to avoid the sideswipe, the crash, the damage to my vehicle, potential damage to myself, because that early warning system told me, maybe you shouldn't do that just yet. The power of an advisor is often so difficult for people to understand, because how do you quantify the mistake you didn't make? Because the advisor kept you on course.
That resonates so much with me. And I'd made an earlier reference to people don't even know what their performance is. Mm-hmm. That would be like, you didn't even know that you almost hit somebody in your blind spot because they swerved out of the way and you didn't have an accident.
Right.
But I also just in general will feel that people want to measure up performance and measure up everything. So that they're like, Vanguard says the value is about 3% over time or more than 3% over time. And you mentioned it's not lumpy, or it is lumpy.
It is lumpy.
Yeah, sorry. You mentioned it is lumpy. I often tell people we'll earn a lifetime of fees all at once, with some clients. And I also will talk to people who are considering hiring us, and they'll say, well, I won't need an advisor for the next few years. It's just like all on plan. It's like, oh, so you can predict the future. You know when your next crisis moment is going to happen. Mm-hmm. It's not just the portfolio, it's your life. People get married, divorced, die, have children, lose their job, get promotions, get inheritances. All sorts of things change in the world. The advisor keeps you on track. Your study does a really nice job, though, of quantifying some of these areas that are measurable. Mm-hmm. To extent. Sometimes there's stuff like, well, hey, we know we need oxygen to breathe, so that's valuable. You say that about financial planning, like we know this is important, but we're not going to try to slap a number on it. Maybe what are one or two of the findings from your study that tend to surprise you or others most?
I think one of the biggest surprises is how significant the value of behavioral coaching is, helping clients avoid the behavioral mistake. And it makes sense if you talk to people in the markets, especially people who are not working with an advisor. There's a lot of this cycle of fear and greed that's driving investor behavior in the markets. So on the one hand, there's the FOMO. This stock has gone up, this asset class has gone up, this type of investment has gone up, and they're chasing after returns that have already happened. And there's no guarantee that they'll continue to happen in the future. The second is the fear those things have done well, And so they can't possibly continue to do well. And so I should put all of my money in cash, in gold, in, whatever else. And so we see these two things happening at the same time. There's people investing based on fear of missing out and fear of what might happen in the future. One of the things that's been really interesting is we see the value of helping people through those moments without changing their plan or deviating from their plan is pretty significant. So on the fear side, we've looked at what happens if a client leaves the market and goes to cash. So let's say go back in time. Earlier this year, the geopolitical crisis, the war in Iran, the Strait of Hormuz gets closed. A client who isn't working with an advisor who's behavioral coaching them leaves the market and goes to cash. Our research shows that one of the biggest challenges for them is figuring out when to get back in. And the longer they stay in cash, the more likely they miss out on compounding returns. Because we see that up days and down days in the market tend to happen in close proximity to each other. So the more time that you miss in the market, the less likely you are to perform as well as an index. So one statistic that I looked at from our materials showed that if a client goes to cash and stays there only for 3 months, so somebody went to cash in February and got back in May, only 3 months, they have a 74% increased chance of underperforming a standard 60-40 portfolio. So 60% stock, 40% bonds. That is incredible, like only 3 months. And there are people who sit in cash for way longer than that. We actually developed a tool on our website to help advisors show clients the size of those mistakes and how long sitting in cash following the global financial crisis or some other historical period can affect their portfolio with real numbers. And it is amazing sometimes the dollar amounts that we see.
Well, it's as you mentioned, the global financial crisis. When you were talking about people going to cash, that's immediately what I thought of. And of all the people I watched during the crisis, or even coming out of it, because in like 2010, 2011, everyone was talking double dip recession. You had like the European debt crisis going on. And we lost our credit rating. Was that in 2013 or 2011?
Well, it depends on which
time, right? Yeah, fair enough.
Yeah.
The first time we lost it, regardless, there was people going to cash, and it is crippling. And you have to be right twice. You have to be correct when you get out, and you have to be correct when you get back in. But a lot of what you're also talking about, to me, falls under this, do you systematically rebalance? Do you have a strategic asset allocation? Now, we actually have a tool on our website that kind of looks through some of these aspects like, well, how good is how much are you doing a strategic asset allocation? Mm-hmm. How systematic is your rebalancing? Because people will say, well, sure, I rebalance. But I'm telling you, even myself, I actually only own one fund currently. And it's, my wife and I, we just automatically rebalances for us. We don't have to think about it because every time I personally, despite the fact that I'm overseeing over $10 billion for clients, it's really easy to be systematic with somebody else's money. But with your own, you don't always have time. You're busy with stuff. You meddle. I think that most individual investors overestimate how good at rebalancing they are and how good at asset allocation they are. And if you're listening or watching this, you should really check out the tool that we've built on our website exactly for this. Mm-hmm. Even smart investors, they get tripped up. I mean, where do you see smart investors getting tripped up the most?
So many different things. I think a lot of them really just get inertia. So they may build a portfolio and they just let it run. And they don't think about how their life has changed. They don't think about how the market has changed. So if we were to look at somebody's portfolio that built it with a lot of individual holdings, or maybe even some, a basket of ETFs, a lot of those portfolios today would be overweight growth, overweight large cap. They wouldn't have much fixed income. And so there is a diversification level that they're lacking. And that portfolio is not as well positioned as a fully diversified advised portfolio where somebody has been watching over it and making sure, okay, we're a little overweight growth. Let's rebalance back to a more blended portfolio. Okay, we we got really overweight US because the US outperformed international for so long. Let's rebalance back to international. Oh, now international is outperforming. So they're missing that rebalancing premium and they're not getting as diversified a portfolio as they expected. And that can really harm people over time, but it can especially harm them when something in their life changes and the need that they thought they were going to have for the portfolio is now shifted in a different direction.
Now, when people come to PlanCorp, there's this moment where they're like, I can't do it on my own anymore. I don't want to do it on my own. I need some help. What does that moment look like according to the research that you all have done?
We find it often happens when people are in retirement or close to retirement, because when you're in that saving mode, what most people are doing is they're deferring to their 401k. The money's being allocated maybe by a default in the 401k, or they're managing it to some degree on themselves, but there's not a near-term need. There's not a lot of complexity. It's almost like, I'm in my house. There's a few things that I can do. I can, replace the light switch pretty easily. But there are things that I need to call an electrician for. All of a sudden the breaker keeps flipping and I can't get it. I'm going to call an electrician.
Yeah, you've already passed my knowledge base. So I've already called the electrician by this point. Yeah.
And so I feel like we see the same thing with investors. They're starting to worry about, how do I make sure that I have enough money to survive through my projected lifespan? How do I think about withdrawal strategy? How do I change my asset allocation as my risk tolerance changes? And those are the types of inflection points where we often see them reaching out for help. Sometimes they start with just having, a fee-only advisor review what they're doing and give them input. But we find the most value comes when there's an ongoing relationship and partnership, because again, that blind spot monitor, you need somebody who's going to prevent you from making that mistake before you make it. And if you come after you've already been in a crash and say, help me, well, great, we're going to do the best we can, but wouldn't it have been easier if we could have avoided all of this in the first place?
Well, I love that you called out some of those transition points. I feel like the playbook for accumulation and investing while you're accumulating is largely agreed upon. It's, keep costs low, save and max out those tax deferred accounts. Decumulation, however, there is no one size fits all playbook. And so as you're nearing retirement, or even if you've just become retired, the amount of moving parts can't be learned in a blog post or a podcast or a single book, because everybody's goals are different. That's the real key. If it's
even your book?
Well, my book is perfect. So that's why it's in the title. But the ultimate thing is accumulation versus decumulation, that there is an agreed upon playbook and you've maybe run it successfully yourself. You feel like, I watch podcasts, I read a lot, I can figure out this decumulation part. But eventually people come to us where they realize there's way more moving parts. And eventually you don't know what you don't know. You go to a doctor and you have read up on WebMD or ChatGPT, some of the issues, but they point out an input that you never considered giving. And it's such a big point. So maybe let me wrap it up with this question. If someone's watching or listening to us and they feel like they probably feel confident they can do it on their own, but they're not totally sure, what would you tell that person to think through?
I think it's important to be a little humble and don't feel like you need to do everything for yourself. Asking for help, asking for advice is not a sign that you failed. It frees you time. It frees you stress. It frees you an opportunity to enjoy this decumulation phase of your life and put some of this in the hands of somebody whose job it is to every day worry about helping you achieve those goals. So it is not giving up, it's giving into the things that you value, which is the ability to spend time with your loved ones, travel, enjoy. What have you been saving for all this time so that you can pore over spreadsheets and tax documents? That doesn't seem like a fun retirement. I mean, maybe for some people, but I think that it is a really important thing to consider. Is this the thing that you want to be stressed about? And I also think about, the challenges that we have in personal relationships. Money, finances can often be a very significant stressor in relationships. So getting an objective party involved that can work with you and your partner, you and your family, to help you think through some of the different challenges ahead can be incredibly valuable. The biggest thing that we see, though, is just knowing that you can pick up the phone and call your advisor and say to them, hey, I saw this in the news today. Should I be worried about that? One of the biggest things that I saw, I was traveling, again, back to the tariff tantrum. I was traveling in the field that month that happened, and I was talking to so many advisors, and I said to them, how have your clients been taking all of this market volatility? And it was great. Almost every single advisor that I talked to said, well, most of them aren't calling because they're very confident that we've got everything in order. But for the ones who call, they say, oh my gosh, what's going on? Is my portfolio down 12%? I see all this volatility, all these headlines. And the advisor was able to say to them, actually, your portfolio is very well diversified. You're down 2% or you're up 2%. And the clients, oh, great, click, back to your life. Isn't that powerful?
It's amazing. And I'm obviously biased. I work for an investment advisory firm. I'm one of the owners. That's why I have you here as the less biased perspective. Financial advice is not cheap. I realize that, but there must be some value to never having to worry about money. Now, there is a cost to hiring a bad advisor. If you can end up with a good advisor that you trust, you can effectively delegate worrying about money. And I think I'm not trying to make the claim that hiring an advisor means you never have to worry about money again, but let's just pretend that a genie grants you a wish that you will never worry about money again. That has some value. And what I love about the Vanguard study, and I love about the tool that's on our website at plancorp.com, is that you ultimately can do some measurables. But I think the thing that gets left out is, yes, this could be one of your biggest expenses that you add to your yearly outflows. But boy, is there a lot of value in that peace of mind. And I know that the studies you do that I've seen in one of the studies that peace of mind was the number one cited thing that investors with financial advisors valued at the end of the day.
Absolutely. That peace of mind is really immeasurable, but we've tried to put a measure on it. The thing that I would like to point out is our research shows, again, that the value of an advisor has compounded to over 3% annually. So yes, you're paying a fee to the advisor, but I haven't come across an advisor yet that is charging more than 3% for that service. And I know PlanCorp certainly doesn't. So the point is that even after paying the fee, you're still significantly better off than you would be on your own.
Well, Liz, this was a pleasure. Thank you so much for joining me. If you're watching us or listening to us, do check out plancorp.com. We will link to this tool that I've mentioned. If you want to see what value an advisor could add to your life, it's a great place to start. We'll also link to some of the research done by Vanguard and Liz. And again, really appreciate your time today.
Thank you. Really appreciate being able to have the conversation with you.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.